Welcome to Talk Tickers. We're your shortcut, really, for getting through all the dense corporate disclosures out there. Today, we're diving into the third quarter 2025 earnings call for a big name in trucking, Werner Enterprises. Our goal here is simple. Cut through the management speak, give you the essential insights. We want to tackle those key investor questions. How bad was the profit hit really? And maybe more importantly, what's the strategy for the freight cycle turn?
Yeah, if you just look at the headline numbers for Q3 25, it was definitely a mixed bag. It sort of created this immediate confusion for the market. Werner actually beat on revenue. They brought in $771.5 million, which is up 3% year over year. That was better than the consensus, which was around $764.2 million.
Okay, beating on the top line in this market, it sounds pretty strong operationally.
It does, but here's the catch. That strength just didn't flow down to the bottom line. Non-GAAP adjusted EPS, it came in negative minus $0.03. That missed the target, which was about positive $0.13. And the margin pressure was, well, pretty severe. Adjusted operating margin dropped only 1.4%. That's a 150 basis point fall compared to last year.
And we saw that reflected immediately, didn't we? The stock sold off on that earnings miss, but then it kind of stabilized, even bounced back the next day. How do you reconcile that? The strong revenue versus the margin disappointment. What did the market end up focusing on?
Well, the first reaction was definitely sticker shock over those costs leaking through. But the rebound, I think investors started looking past maybe some of the one-off items. They started focusing on the bigger picture, the strategic story, the macro narrative. Werner seems to be executing on growth and costs, and they're getting ready for capacity getting tighter. So the question really became, how much of that Q3 pain was just temporary? And it's interesting where that profit erosion really hit hardest. It was mainly in their main trucking division, the Truckload Transportation Services, or TTS segment. Their adjusted operating margin net of fuel was only 1.9%. That's down 340 basis points. And management pointed specifically to higher insurance and claims expenses for a huge chunk of that, like 200 basis points of the decline.
Wow, 200 basis points just from insurance. That's a massive headwind. But, is that just an excuse? Was it really unavoidable? Or maybe does it hide some issues in how they manage claims or price risk?
Well, it's definitely an industry-wide problem, that insurance cost pressure. But yeah, the size of the hit for Werner was pretty notable. Their costs were way up year over year. And they did admit that the prior year's Q3 was unusually low on insurance, below $30 million. So the comparison was tough. The cost curve is definitely steepening for everyone. But you're right, the scale of it suggests they're maybe recognizing risk very aggressively right now.
And we shouldn't forget those specific non-GAAP adjustments either. They made the official GAAP number look even worse. That $18 million class action settlement accrual plus, what was it, $3.4 million in legal fees, that hit the quarter pretty hard.
Exactly. Those items, they take them out for the adjusted EPS number everyone quotes, but they still amounted to a $0.26 negative impact on the GAAP EPS.
Yeah.
So yeah, it really paints a picture of a quarter hit by some significant external costs and maybe some cleanup.
Okay, let's unpack the actual business segments then. Where did that revenue growth come from? Because beating revenue by that much wasn't an accident. You mentioned logistics grew 12% year over year. That seems key.
Absolutely. Logistics was definitely a bright spot. And it was heavily driven by their digital platforms. Powerlink revenue was up like 26%. Intermodal shipment volumes jumped 23%. So it shows those tech investments are definitely gaining traction, pulling in volume. The only caveat there was even logistics saw some gross margin pressure. They had a shift in business mix, more stable contractual stuff, replacing some higher margin project work they had before.
Okay. And switching over to the main TTS trucking side, Dedicated kept growing, right? That's their big strategic focus.
Yeah. Dedicated revenue net of fuel was up 2.5%, and it's now, 65% of their total TTS trucking revenue?
Yeah.
Their average truck count in Dedicated also increased, about 1.2% year over year. So that growth engine is working. But the flip side was the traditional one-way segment. It definitely felt the pressure.
How so?
Well, they saw decreased miles per truck in one way. Management was clear, though. It wasn't just soft demand causing that. It was directly linked to shifting trucks around and bringing on new drivers specifically to fuel that dedicated expansion we just talked about. Basically, it created some temporary bumps, some inefficiencies in the network that hurt productivity in Q3.
Right. Network inefficiencies. Makes sense.
And if you tie all this operational stuff back to their capital situation, you see they're being careful. Operating cash flow was $44.1 million, down 28% year over year. But look at net capital spending, they pulled way back, down 60% to $35.2 million. So they're being really selective with spending. It suggests they're preserving firepower, maybe getting ready for something, playing the long game. Their net debt to adjusted EBITDA is solid at 1.9 times.
Yeah, holding back on CapEx definitely signals they think the market might be turning. And that's something they're gearing up for, has to be tied to their strategy. Let's dig into those pillars: cost discipline, tech transformation, capital efficiency. On the cost side, they seem pretty serious. I mean, they hit 80% of that big $45 million cost savings target for 2025 by the end of Q3. And they sound confident they'll hit the full amount by year end and keep that discipline going into 2026.
Yeah, and the technology piece is crucial for where they go next, efficiency-wise. It's more than just saying OpEx reduction. Management said their big multi-year tech overhaul is in the later innings now. You can already see benefits in logistics, like we said, OpEx down, volume up, that PowerLink surge.
But what about implementing it on the TTS side, the main trucking operation? That sounds like a bigger challenge.
Oh, it's definitely the heavy lift. Managing routes, trucks, drivers for the asset side is just inherently more complicated than, say, the brokerage side. Management stressed that, yeah, it's happening, but the real payoff, the margin benefits, those efficiency gains, they expect those to become much clearer, more consistent in the coming quarters as the system fully rolls out across the fleet.
Okay, so internal levers seem positive, but they did tighten their full-year guidance, which kind of spooked the market initially. They trimmed the outlook for the TTS truck count, now expecting down 2% to flat, instead of up 1% to 4% previously. And they narrowed the guidance for dedicated revenue per truck per week, just flat to up 1.5% now for the year.
Right, and that tightening ties right back to those operational frictions we talked about, especially the dedicated startups. But here's a key detail management shared, something really important for Q4. Those startup costs were high in Q3, over $2 million, hit EPS by about 3 cents. But they said those costs were already down 75% in October, and they expect them to drop off fast. That should provide some definite margin support heading into Q4.
Ah, okay. So that built-in cost normalization, that leads us right into the macro picture. And that was maybe the most interesting part of the call. Management spent a good amount of time putting Q3 into the context of this really weak overall truckload market.
Yeah, the near-term market is still soft, no doubt, but the really compelling story coming out of the call was about capacity attrition, the supply side. Management said the pace of trucks leaving the market is actually picking up. You're seeing small carriers go bankrupt, but crucially, also regulatory enforcement starting to bite.
Okay, let's clarify this because we hear a lot of jargon. They mentioned two big regulatory things hitting supply. First, enforcing English language proficiency, ELP. They think that could take 30,000 drivers out annually. What exactly did that mean for carriers?
Well, the ELP rules are basically about safety and communication. Drivers need enough English to, read road signs, talk to inspectors, fill out paperwork. If enforcement ramps up, it could disqualify thousands of drivers who maybe weren't fully compliant before, hence that 30,000 number. And the second one, potentially much bigger, is the non-domicile CDL issue. Management gave a frankly stunning estimate, a conservative estimate, of 200,000 drivers impacted. Basically, this involves drivers who got their commercial licenses in states where they don't actually live, sometimes using loopholes. If there's a crackdown, those 200,000 drivers could just lose their licenses overnight. That would be a massive shock to supply.
200,000, that's potentially industry changing. They're really betting on that enforcement happening. What's the risk? What if it takes longer? Or those drivers just find ways to operate under the radar in smaller outfits?
That's definitely the counter-argument. But Werner's management seemed pretty convinced. They argued the combined effect of cracking down on B-1 visa cabotage, ELP, and these non-domicile CDLs could actually pull more capacity out than even the ELD mandate did a few years back. They seem to think the regulatory net is tightening, closing off those loopholes.
Okay, so if they're right, if that capacity really does exit, what does it mean for next year's contract negotiations, the 2026 bid season?
It probably means a better bid season than we just saw. All that pressure on capacity should give carriers more leverage. It should push rates back towards what management calls reinvestable levels, basically, rates where they can actually make a decent profit again. They also mentioned that insurance companies are getting tougher too, scrutinizing carriers more on these compliance issues. That adds another layer, especially for smaller guys.
And near term, what about demand right now, heading into peak season?
Yeah, they said demand did pick up through September and October, which is pretty normal seasonality for them, given their focus on retail customers. They're expecting peak season volumes and pricing to be roughly similar to last year. So steady, but not spectacular on the demand side yet.
All right, that brings us to our final segment. Time to take all these insights and spin up an outrageous but maybe plausible trade idea. And remember, folks, this is just for fun, for thinking things through. It is absolutely not financial advice.
Okay, so the core idea here hinges on that disconnect we talked about. The immediate EPS pain versus the potentially huge long-term supply squeeze. The market initially sold off on the Q3 miss, right? But maybe, just maybe, it's seriously underestimating how fast capacity could exit because of these regulatory crackdowns. You could argue there's a structural floor being built under trucking rates right now that isn't fully appreciated.
A structural floor. Interesting.
Yeah, so you combine that potential supply shock with Werner's own actions, that $45 million cost-saving plan they're already 80% done with, plus the fact those dedicated startup costs are dropping off right now. It feels like a coiled spring, potentially ready to release heading into 2026.
So internal improvements meeting external catalysts.
Exactly. So the trade idea. Go along the stock. You're betting that Q4 already shows sequential improvement in the TTS operating ratio because the startup costs fade and maybe pricing firms up a bit, even if seasonally it's not the strongest quarter. It's basically a bet that this 200,000 plus driver attrition thesis plays out, maybe causing a really sharp, maybe even non-seasonal spike in spot rates early in 2026. That would then force contract rates much higher in the next bid cycle, leading to a potentially massive earnings surprise down the road once the market fully digests the new supply reality. So just to recap quickly, Werner had a tough quarter on the profit line, no doubt, dragged down by insurance and those settlement costs. But strategically, they seem pretty well set up. Logistics growth was strong, dedicated is expanding, they're cutting costs aggressively, and the balance sheet looks flexible. They seem ready for this capacity shakeout.
Right. So the key takeaway for you, the listener, is probably this. Yes, there are near-term profit challenges, big ones. But look at the long-term moves, the tech investments, the fleet strategy, combined with these potentially powerful macro tailwinds from capacity leaving the market. It suggests management is really positioning the company to capture significant margin upside when the freight cycle turns, which leaves us with a final thought to chew on. If management is right or even conservative about those driver attrition numbers from ELP and non-domicile CDLs, how fast could this market flip from a buyer's paradise to a shipper's nightmare? What kind of unexpected cost hikes could shippers be facing in 2026? Something to think about. Thanks for diving deep with us on Talk Tickers.